Coca-Cola just reported this morning, and they matched on earnings per share, and they beat on revenue. So they were expected to make 45 cents per share, and they reported exactly that. And they were expected to do $10 billion in revenue. They did $10.1 billion. What is the stock doing now after the market has opened? It's currently 1 hour, and all right, it's pretty much even. I mean, it's down negligibly. So look at Coca-Cola. This is when Warren Buffett bought Coke, by the way, right where our data starts. And including dividends, I did the math recently, he's made about 11% return on his money, which actually isn't that great.
No,
not
for him.
But he also used leverage. People don't remember that Warren Buffett uses leverage by using the float from his insurance companies to buy great companies. And I think that you would sit there and make the argument that this has been a pretty steady increase over time. Yeah, it's had its bumps. I mean, look at this. It hit a high of 40. So look at this. Since 2000, the peak in 2000 was what? $44. At COVID, the low of COVID,
$44.
$38.
Okay.
So you made dividends along the way, because right now the dividend yield in the company is 2.2%. But look at this. This is what he loves. High return on invested capital. Mm-hmm. And this is a huge moat, guys. Like literally, what's the market cap for Coca-Cola? Let's do our example here. $260 billion. Mo, if I gave you $260 billion today, can you replace Coke?
No, and frankly, there is another company that tried to do that, and Pepsi, and they haven't.
Yeah, Pepsi's doing well. Don't get me wrong.
Well.
They've done very, very well.
I mean, Coke is in everywhere in the entire. It's basically a word that everybody in every language understands.
So the big thing, though, guys, is I want you guys to understand that I basically keep Coke in business.
Yeah.
I drink 6 to 8 Coke Zeros a day. For those of you who are going to judge me, I don't care. This is what I say to you for judging me on that. I love Coke Zero.
Did you just flick off the camera?
I did flick off the camera.
I looked away.
I love Coke Zero. It is the only vice I have. I literally, it's funny. My fiance and I joke. She says I rate restaurants based on their pop, and she's 100% right. I bring. There's a great Luna Cafe in Moreland Hills. We go there every week. Mm-hmm. I bring Coke. I go to the gas station across the street, buy a Coke Zero, bring it over. They don't care. I have to because they don't have pop.
What?
They go like, oh, we have this like ginger stuff. I'm like, come on.
They're homemade.
Yeah, whatever.
Voodoo.
But it's a great. They have a great tuna salad sandwich.
Really?
Oh my God. At least like I can make that. I'm like, you probably can't. So anyhow, let's look at Coke from an investment perspective. So again, really large return on invested capital, deserves a premium. Market cap is 260. Enterprise value is 320. That difference is essentially the debt on the company net of all cash. This PE is 26. The 5-year PE is 35. Right. You should pay a premium for this high return on invested capital. But the question becomes, how much of a premium should you pay?
Right.
That's the big question. All right. Let's take a look at the 8 pillars on this company. 8 pillars. All right. Slight increase in shares outstanding. Debt, I'm not worried about because it's Coca-Cola. But these are the big numbers. 5-year PE and 5-year price to free cash flow. Now, guys, if you're new to this channel, these 8 pillars doesn't mean if it's all green, you go buy it. If it's all red, you avoid it. It's a way of telling a story about the company, right?
Yeah.
We don't know if this is too much. Why? Well, the company was going to grow 100% a year for the next 10 years. I would pay double that probably, or maybe even more, to get a good return on that company.
Plus, I see, not looking at those, I see 15.7% ROIC, and I go, oh, okay, they get a really good return on the capital that they invest in themselves.
Yeah.
So maybe it justifies it.
Correct.
Who knows?
Now, a couple of things, though. The dividend yield of 2.2% pays out $5.7 billion in dividends. Now, you might hear that, and like most financial planners out there will say, oh, this is a great dividend. Well, can they afford it? Well, what my goal is, they have $8.5 billion in free cash flow over the last 5 years on average. They're paying out 5.7 of that. If it wasn't Coke,
that's the thing.
That's a lot. Yeah. I'd be like, But last year they did $10 billion in free cash flow. Again, if it wasn't Coke, I'd be concerned because you shouldn't take a dividend as set in stone and always affordable. Remember, a lot of companies know that the average investor wants a dividend. They might even borrow money or issue shares to pay a dividend just to attract investors to their stock to drive the stock price up. All right?
They did have a very big jump in free cash flow in 21 and 22 compared to the previous 8 years. So it's maybe something to think about. and say that is quite a bit. But again, it's Coke.
It's Coke.
It's Coke.
I'm okay with this dividend.
I am too.
I'm not worried about this dividend yield.
I am too.
I'm okay with it. But I want you to realize when you're watching this video, if you're new to the channel, that we don't speak in just ways of accepting what we see. We're asking questions.
Yep. You don't just go buy this for the dividend.
Yeah. Listen, I remember 20 years ago, I met with a lawyer who was in charge of a trust, and he literally bought GM because like, hey, it's a 5% dividend. I remember looking at him, and back then I wasn't the investor I am today, and I was like, well, it's GM though. They're a car business. They could easily just have a bad run. He went like this. GM went bankrupt, 4 years later?
Yeah.
It's like, now you know it took the financial crisis for that to happen,
Right.
but don't just trust a dividend because they pay it. You got to understand, can they afford it? That's the big thing. All right, what are analysts saying about Coca-Cola? EPS. Now look at this. Pretty decent growth in EPS. That's what the return on invested capital does. It allows them to invest less and less money needed to drive that earnings per share. Let's look at their revenue growth. They only have 2. Wow, I'm surprised at that number of analysts.
Too.
Or maybe because they think it's boring.
Maybe so.
All right. Okay. So what do you pay for? What are you going to pay for Coca-Cola? So guys, this is our stock analyzer tool. It was used 1.3 million times last year by the thousands of people in our community. It was by far the most popular part of our site. Even though we have all these other tools, that was the most popular. If this software is interesting to you, we have a special we're running during earnings season, $7 for 7 days. Check it out, try it out. It's $1 a day. We have had so many signups from it, and very few people have said, because it's an awesome offer. So check it out, try it out, and you'll very much enjoy it. Mo, you're going to do a 10-year analysis.
Yes.
I'm going to do a 20-year analysis. The reason I'm doing 20 years, Coca-Cola is the kind of company that you should want to own for a very long period of time if you buy it at the right price. I'm going to factor in, we're going to look at our revenue growth, profit margin, free cash flow margin, assign an ending PE, and then our desired return. Now, for those of you who watch this, we are expanding what we're doing on the stock analyzer tool. We're going to show you the 10% returns. Why 10%? Because 10%, we perceive 10% for us to basically be intrinsic value. Because if you invest in the stock market in a low-cost ETF, you should make 9 or 10% a year over long periods of time. So the higher your return, the more margin of safety. So we're going to start with 10% on all of our assumptions, and then we're going to put in margin of safety to show you what we think we would buy it at based on our desired return. So Mo,
sounds good.
Get started.
Okay.
I'm going to go with, this is actually a harder one than most.
It is harder than I thought it was going to be.
For sure. Yeah, so we're sitting here making assumptions. And guys, remember, that's the issue. This is the art of investing. We don't know the future. We have no idea what the future holds. So you have to make your assumptions, and you shouldn't buy a company if you don't have some sort of understanding of the economics of the business. Mo, why are you smiling?
I'm smiling because I just saw it on my watch list down here at $18.15, and I don't know why. I don't remember.
That's a very random number.
Yeah.
All right, revenue growth. What do you have in there?
So I did 3, 5, and 7.
I did 3, 4, and 5.
Okay. Profit margin, 17, 19, and 21.
I did the same thing.
Oh, wow. Free cash flow margin, 18, 20, and 22.
I did 19, 21, and 23.
All right.
Now, for those of you out there real quick, we were different here because I did 20 years. As the company gets larger and larger and larger, it's going to be harder and harder to grow.
Yep.
I think 5% revenue growth might be low.
Could be.
Well, actually, I do think that is low. I'm going to do your numbers. I'm going to do 3, 5, and 7%. That's doubling every 10 years.
So I will say I think 3% is very low, but
okay.
I had to have a starting point.
All right, so PE.
PE, I did 14, 16, and 18.
See, I think that's too low, Mo. This is talking about Coca-Cola. High ROIC, major moat. I did 16, 17 and a half, and 19.
What did you do?
16, 17 and a half, and 19.
Okay, I'll do the same thing. How about that?
Now, guys, don't be the person that just just puts a PE, a price of free cash flow in, just based on where the current PE and price of free cash flow is.
Correct.
No, look at the long-term average of stocks, 15 or 16. That's why I signed that to below at the bottom.
Okay, and then
we did our
10%
10s.
return.
Okay.
Let's see.
So this is based on if these numbers come up correctly, what the intrinsic value for the company is without including the balance sheet. All right. I have a low price of 25, a high price of 55, a middle price of essentially 40. Mo, what do you got?
Yep. 25 on the low end, 50 on the high end, 35 in the middle.
Now that assumes buying with no margin of safety.
Correct.
So I'm going to now change this to 10, 11.5, and 13. I hit the analyze button, and of course the numbers drop significantly. 25 in the low, 38 to 40 on the high, low 30s in the middle.
Pretty much the same. 25 on the low, 37 to 40 on the high, low 30s in the middle.
Now don't get caught, guys, in worrying about how these numbers are lower than this.
Yep.
We're in a very big bull market, so we appreciate this. Guys, if you like this video, subscribe to the channel, and don't forget the $7 for 7 days. Take care.